Is the Fed's rate cut party over before it began? Wall Street took a breather on Thursday, with major indexes closing in the red as economic data threw a wrench into the hopeful narrative of imminent interest rate cuts. But here's where it gets interesting. While initial jobless claims surprisingly dropped, signaling a potentially stronger labor market, other data revealed the U.S. economy grew faster than expected in the second quarter. This mixed bag of news left investors scratching their heads, wondering if the Federal Reserve will hit pause on its rate-cutting plans. The data dilemma. Jobless claims dip. Initial claims for unemployment benefits fell by 14,000 to 218,000, suggesting a resilient job market. GDP growth surprises. The U.S. economy expanded at a faster pace than initially thought in Q2, fueled by robust consumer spending and business investment. This raises questions about the urgency for rate cuts to stimulate growth. Fed speak adds to the confusion. Chicago Fed President Austan Goolsbee expressed unease about rushing into rate cuts, citing lingering inflation concerns. This contrasts with the Fed's recent 25 basis point cut and hints of further easing. Investor expectations for another cut in October have dipped, reflecting this growing uncertainty. And this is the part most people miss. While the Fed aims to balance inflation and a potentially weakening job market, the recent data paints a picture of an economy that might not need as much stimulus as initially thought. Market reaction. The S&P 500 ended lower, with most sectors in the red. However, energy stocks bucked the trend, rising 0.9%, and technology eked out a tiny gain thanks to a surge in Intel shares following rumors of a potential partnership with Taiwan's semiconductor manufacturing company. CarMax, on the other hand, plunged over 20%, after reporting disappointing quarterly profits, highlighting the vulnerability of certain sectors to economic shifts. Looking ahead, all eyes are on Friday's release of the Personal Consumption Expenditures Price Index, the Fed's preferred inflation gauge. This data point could be a game changer, either solidifying the case for further rate cuts or prompting a reevaluation of the Fed's trajectory. The controversy: is the Fed overreacting to temporary economic wobbles, or is it wisely preparing for a potential slowdown? Should they prioritize fighting inflation or stimulating growth? The answers to these questions will have significant implications for markets and the broader economy. What do you think? Is the Fed on the right track, or are they risking a policy misstep? Let us know in the comments below.